Hey, everybody, Brian Foucher and the rest of the team here. We'll go ahead and get this thing rolling. So go ahead and get those questions into the chat box over there, the comment box, and we'll see you here in 14 seconds. All right, everybody, welcome to another Ask Me Anything, where we answer all of your questions live. So we'll go ahead and go around the horn here in just a moment. I think Chris is I don't know what Chris is doing right now, but Chris is not going to be on this call. I think Stephen also is a MIA, but we got our solid team here. So go ahead and get those questions into the box right there, and we'll go ahead and get this thing rolling. So everybody, I'm Brian Fouts up here in Northern Idaho. Actually going to be traveling the next week and a half. I think I'm going to be seeing some of you in Whistler. Craig, are you going to Whistler?
I will be there.
Okay, I'll see you there. Away. Yeah, so I'm actually traveling. I got 5 plane flights I'm on tomorrow. So 5 flights all in one day, going all through Idaho, Washington, Alaska, and Arizona all in one day. So it's going to be a long, long day. So looking forward to that. But I'm going to some training here this weekend, and then seeing some of my colleagues up there in Whistler this coming week. So looking forward to that. With that, I'll go over to Ethan.
Hey guys, Ethan Evans here from the implementation team and Money Mentor as well. I also am going to be doing some travel in the next couple of weeks, but sadly not for IBC reasons for my National Guard commitment. So I'll be away for training there to rethink my Army thinking, and then excited to get back to you guys by like the last week in June. So that's all from me. So over to Joe Helock.
I'm Joe. I'm in Buffalo, New York with Chris and Shauna, who aren't on today because of other things. But today it's actually nice outside. I think we actually broke 80 today, so that's a step in the right direction. And here to answer your questions, and down to my buddy Craig.
Hey, thanks, Joe. Yeah, Craig Yenny here, just south of Denver. And I got to tell you something. I got a vest on, and you're probably wondering, like, what's wrong with this guy? Is he sick? Well, here's the deal. I shut the heat off, and I'm not turning it back on. Woke up this morning. It's just cold outside. It was 60 degrees in the house. It's warmer in the winter. Anyway, I'm just chilly, so I got the vest on. And here to answer your questions. And I'm really happy to see you have our good friend Tess. So introduce yourself.
Hey, everybody. I'm Tess, and insurance has been my life for over 30 years. I was in the finance department of some of the insurance companies locally and decided that this team is amazing and jumped on this side about 5 years ago. From what Shauna told me when she asked me to join us, Chris will be joining later, but he will be here. And next week, I won't be in Whistler with you guys, but I'll be in New York with Linus. We're going to the SML training. So now I think it's over to Bree.
Hello, I'm Bree. I'm still up here freezing in Alaska. We're getting a lot of rain right now. Not feeling like summer, but I'll be up here while you guys are in Whistler too. So I get to keep looking forward to it. I'm Joe's partner, and I'm looking forward to answering all your guys' questions. I'm going to take it over to Jason.
Thank you, Bree. Hello, all. Happy AMA Wednesday. It's Wednesday, right? Glad to be here. Wasn't sure if I would have been here since I was backstage. So surprise, here I am. So let's rock and roll. We got some questions already in the chat. So let's have some fun. Let's get to it.
All righty. Did Joe already go?
Whatever.
Did you already go? We didn't hear you.
I already went.
You said, yeah, it's kind of warm here in Buffalo. It's 85.
Oh, that's right. Yeah, warm in Buffalo.
Yeah, remember?
All right, let's get into the comments. Yes, any questions you guys have, go ahead and put those into the box right down there. I just saw that we actually don't have any connection to Facebook right now, so I don't know if anybody's going to ask questions on there. But that being said, I see that Shane has some questions already, so we'll go ahead and get started here. All right, so Shane's saying,
questions have been getting harder, Brian, by the way. Have you noticed that? Yeah, the more difficult, I think. Yeah. Okay.
Yeah, which is good. The more you get into it, right? So my AUL One America policy is about to have its second anniversary date, and I received a letter asking if I want to allocate a percentage to IDO.
No, that's a paper airplane or garbage.
Yeah,
whichever you want.
What IDO, by the way, is index dividend option, which means your dividends would be tied to an index or index, which obviously part of infinite banking is to not be tied to the markets. So, and that's what he says right here. I'm assuming I don't, because the idea was tied to the market. Exactly right there. So, yeah, the whole part of infinite banking on our side, and if you study it, the whole thing behind it is to not be tied to volatile assets or volatile markets and remove your money from those systems in the first place so that you control it. So we'd rather have, guarantees and all that kind of stuff and not the volatility of the markets.
Just so everybody knows, AUL always will send out this piece of paper every year. They don't know what we do. So it goes out to everybody, and you guys are with us. So therefore, you know what to do. Crumple it up and throw it in the garbage.
There you go.
Yeah.
And then Dina just asked, greetings everyone. How and where do I ask questions? The same way that you ask that question is how you ask questions.
Yep.
Nailed it.
I was confused for a second. I'm like, wait a minute.
Yeah.
I didn't know what to tell her.
However you just
I
ask
didn't
that
know the
question
answer.
is the way you ask all questions. Yeah,
Just
there you
like
go.
that.
Yep. Okay, so let's see here. We have another one from Shane. So, and leaving the policy alone as blended insurance is the way to go. Please advise. Thank you for your help navigating these questions. So, blended insurance. I'm assuming you're referring to blend as in paid-up additions to base premium. You can't really change that. I mean, you can always go lower on the PUA side, which would reduce the amount of going to PUAs. But yeah, you really can't change that once it's set.
I'm wondering if he has the EBIR, and that's what he's talking about.
Maybe, yeah. That's one of them.
Can't do anything to that either.
So once they're kind of set, your maximum is kind of up here. You can always go lower on the PUA side, of course, but yeah, it's pretty much that you're good to go. So hopefully that's what you're asking.
Pay your interest and pay the whole thing, and then you don't have to worry about it for next year.
Okay. And remind me when we have some time. I have a question that came in from somebody else privately, so I want to make sure we ask it here live. All right. So Derek is asking, I have a first-time home buyer grant that is a second mortgage on my home. It has a 0 payment and a 0% interest rate. The full grant has to be paid back if I sell the home and refinance it. Can I get a HELOC? Yeah, because that would have to be a third position HELOC, and I don't think they do those, Joe, do they?
No, I haven't.
I've come across this before when I was doing subject to financing, and it had 2 liens on the property. It had a first lien mortgage and then a second lien grant. So I don't believe that you can get a HELOC because it would be third position.
It has a 0 payment and a 0 interest rate.
Yeah, it's a grant. Yeah. So what happens is it allows you to buy the home with a grant that you don't. It's a government thing, I believe. And then when you sell the home, that has to pay that off.
But why is it a second mortgage? If it's taking out the first,
It's not taking out the first.
It's not.
No. You have a mortgage of a certain balance, and then you have this grant behind it that covers the rest of the purchase price.
Yeah, which means they probably have little to no equity in to even make the difference of getting a HELOC.
We still have to have the 20% down and stuff. That still has to occur in most cases when you're doing this. But yeah, it's pretty interesting. I've come across this before. And it was kind of cool. But I bought a property subject to and had that grant stay in place. It was pretty cool. And then when I sold the house on the back end, when they refinanced it, it just paid off the grant. It was done. It went away.
If it was going to be a 0 payment, like if they had that 20% equity in the home, they should still be able to get a HELOC in the first position that pays off the balance.
You can do it all in one and wipe out both of these things. That's what you could do right there. But I'm pretty sure you can't do a third lien HELOC.
No. And I shudder at the thought of just getting more and more debt lines on the same.
Yeah. But I mean, Derek, the best question would be to go to one of the banks and just ask them what you could do with the HELOC. That'd be probably the best option because this is a very unique situation.
But if I could buy a house with 0 payment and 0 interest, I'm all in.
Sign me up.
Yeah.
How about you, Chris?
Bob, Joe, you taking notes?
Know.
What bank is that? Where are we going tomorrow?
I don't know, but I'll be there in 20 minutes. We're going to go in person.
I should go back and look at the one I had. So the first position was
everything.
Yeah, well, the first one was a traditional bank, right? And then the grant was like a government thing. So there's 2 separate entities doing this. But I don't remember the program, but yeah, it was kind of cool. And I was doing it. The mortgage payment was like nothing. It was so small.
That's called $1 down and $1 a year. Sign me up.
Mm-hmm. That was awesome. There you go. So that's a good one. I like that one. Thanks for asking that. But yeah, if you have any clarifying questions or comments, let us know. All right. So Dina asked the follow-up question here. So, right here. So 76 years old, 150K in debt, 90K of it is in HELOC. How can your strategy help?
What's the income?
Yeah,
Well, the challenge here is 76, so they won't write a whole life policy at 76. At 75 or 74 is a limit in most cases, if I remember correctly. Is that right, Ethan?
First question I'm asking. I'm immediately moving away from IBC just because unless we could do it, unless we had like a child or someone else we could do it on. And I'm thinking, okay, got a HELOC already. How much more has your house appreciated since you got the HELOC? So if you got 90,000 in a HELOC, if your house appraised today, how much is it worth? And then how much more equity could you get? And then what I'd do is probably Joe, or Craig, a first lien HELOC, wipe it all out, put it into one, use the extra equity to kind of pay off the debt.
Yeah. And how much is that HELOC for? Like, is it a 200 and 250 HELOC line that they have?
I would assume if she's
cards over here and 90
out.
or
Maxed out as
that's why I'm like,
I would assume it's maxed out. I mean, I'm just making an assumption, but 150,000 debt, 90 of it's a HELOC. I could be off. I mean, a lot more questions on this one.
Depends on the
immediately.
income.
What's that?
Depends on the income and 45% DTI, and if she can get another HELOC. There's a lot of other things in place.
Yeah, I agree.
But utilizing the HELOC as you have it, with every penny that comes into the house, we want to put it into that HELOC to drive that interest rate down per the month. And then you could utilize that as a one-pot system. And hopefully after a few months, you'll be able to save on the interest because of the velocity that you're performing. And then that might ease up a little bit, but it's going to be a long road. Yeah.
I definitely would study velocity banking. Just go to YouTube, go to Christy Van's channel or firstlienheloc.com. I don't know if Chris is talking to us, but he's probably not.
No, sorry.
Yeah, okay. Making sure. So hopefully that answered the question. All right. So here, see. Another question here from Glella. Hello all. Which non-direct whole life companies other than One America do you work with? So, obviously One America, Lafayette Life, Security Mutual of New York. Those are the main top three that we work with.
Yeah.
And then a direct would be Guardian or Penn, but maybe mainly Guardian if we do direct.
Well, I mean, we can write with Penn. I wouldn't write a policy with Penn.
Yeah.
And Mass Mutual.
And Mass, if you don't need the money in the first year.
Yeah.
Mass is a great option. I still quote Mass all the time, but to people that don't need the money in the first year.
Yeah.
Which surprisingly is a lot more people than you would think.
Yeah, actually, guys, I agree with that one too, for sure. Especially juvenile policy. Charles, good question here. 61, widow with no kids, major health issues. Is there any way to do BYOB without whole life?
I know somebody has a video on that.
I do. I have a matter of fact, I'll do you a solid. I'll try to find it. It was really good. It was kind of for people outside the U.S. and Canada that wanted to use the infinite banking concept or be your own bank, but couldn't get the policy. So I think that'll help you, Charles. I'll find that video in a second and I'll post it over there in the comments. So you just have to grab the link and watch it. Remember, IBC, the infinite banking concept, is just a process. It's not a product. It's just made a lot better with the whole life. But agreed, 61, widow, no kids, and major health issues. Like we can just rule that right out and just go right into let's teach you the process.
Yeah, good one. All right, guys, get those questions in. We only got a couple left. Otherwise, you're going to hear us talking nonsense.
Well, I mean, let's go back to that question, though. Maybe we can give them a little bit, like Chris said, it's just a process. But maybe talk why whole life could still be the best option to use for the process if he can qualify, right? Like even if it wasn't important when he's leaving for a legacy, as far as a container goes, what would be a better option depending on his goals? Nobody.
And Chris or Brian, I don't know if you guys have the ability to take the private chat and put it into the public chat, but I put that video that Chris was talking about in there.
Yeah, I just put it in there too. But I was
Yeah,
having
I
an
guess I
issue.
did.
Like one of the feeds had an error. That's what I was monkeying with here.
Facebook.
Yeah, Facebook's got some issues right now.
Yeah, it's not
I think
linked into StreamYard right now.
Well, I think we need to reconnect. Is all.
Yeah, I'm not going to do that, but
No,
I mean, you can. Yeah, I mean, as far as like what you're asking, Jason, another way to do infinite banking. I mean, you can use a cash combined with loans, and that's how we actually show it in the video. So like if you want to use infinite banking for like a car loan, you put it into a high yield account and then use a loan, and that's one way to do it. If you have a 401k, I mean, he says he's a widow, but I mean, if you're still employed and have a 401k, you can do infinite banking with a 401k loan. That's another way to do it.
Wasn't so much asking other ways to do it, more just what would be the best way to do it if he has access to whole life, because whole life's still offering you the tax-free growth. It's uninterrupted compounding. It's protected against liens and judgment more than it would be in the bank or other systems. It's more liquid than most other systems. So, other than using like a high yield. So like why, I mean, Charles, you're kind of in the right around halftime or beginning the third quarter as far as like the whole life cycle. So unless there was an immediate need for all of the capital, it still might be your best option.
I mean, the way you can participate in it, if with health issues, is you can buy a policy, somebody else, buy a policy on another person that is selling their policy for some reason. There is a market out there for that, and you can always reach out privately to find out what that is. I don't really know how it all works, but our team does. But yeah, I mean, we have clients that have bought policies from other people. They don't have they don't know the person, but they're able to get around it and buy the policy and use it just like infinite banking.
Yeah, so, Charles, did you get that video link that I put up there? I didn't know if it went through because that Facebook not working, but
it went through.
We can see it.
Okay, if you can see it, yeah, Charles, grab that video, and if you can't, it's a video on my YouTube channel at the Chris Nago. It says "What is IBC?" But the title is "What is infinite banking, and how can I use it outside North America?" And that'll be the best. I think that's the best starting place for you.
Yeah. There we go.
But I agree with you, especially once PMC Wealth is up and running with the cash management. That's kind of the purposes. The cash management division of PMC Wealth is going to be kind of like for the use of the segregated accounts, but you get interest on it. But it's also going to be a starting place for people that can't get the policies to continue doing the process and help with the management. Because along with the packages, and I can't really talk too much about it because Brandon's the advisor, but along with the packages is a service that we set up almost 2 years ago now. Holy cow, time flies. Called Done For You, which was built for the infinite banking concept. So we're going to be wrapping that into PMC Wealth in the retainer model. So stay tuned.
Cool. All right. Mr. David Adams says, it seems that starting a policy, I would want to pick a company without a lot of PUAs on the books in order to have more available to pay dividends. Am I looking at that incorrectly?
Without a lot of PUAs.
Well, when we were at One America, was it 2 years ago, last year, 2 years ago, they did that pie chart and they showed that 2% of their entire portfolio had to do with policy loans. So
which is about a $30 billion portfolio. And that's it's pretty similar across the board for all companies. And if they're direct, it just means it's a non-performing loan, right? So
I keep reading David's question. Yeah. And I think you're missing the boat. I don't think he's asking about the loans. He said, I would want to pick a company without a lot of PUAs, paid up additions on the books. Actually, you actually would want, I hate to say this, and this is probably not compliant, but you would want a company with a lot of PUAs because that means there's less risk on the company. Because a PUA, I mean, yes, it increases the death benefit, but it's not like buying base. Like, if you're looking at, this is really getting technical, but if you're looking at an insurance company, I mean, the biggest risk is everybody dies or a mass amount of people die, and then they got to pay out all their claims. So PUAs are not a claim. They increase the death benefit, but they're not a component of, they're not death benefit themselves. So if a whole life company had a whole bunch of PUAs on the books, that means they're kind of just holding money and paying you interest on it, but they're not really at risk. I would look at that as being a super positive thing. And it really would have nothing to do with paying dividends. Matter of fact, hell, I would assume it would help dividends because if they're paying less claims, they're more profitable.
Well, and the base creates dividends as well down the road. So I mean, you'd almost have to know the seasoning of those premiums.
Correct. Yeah, I don't really see the correlation between the PUAs and the dividend question. So I think, David, maybe just reframe the question, kind of asking it a little bit differently. And we want to make sure we get your question answered. And it's kind of just difficult to answer because you're really asking a strange question, but one that doesn't really correlate. The dividends and the PUAs don't really correlate is how I'm reading it.
Yeah. Cool. Hope says, why would FSB sell my all-in-one HELOC to North Point?
They do that. They have a whole division. So they have a whole division that's what they do. They originate mortgages, and then they sell those mortgages off to Fannie, Freddie, and other banks. It's a very common point in the industry. Banks typically sell off mortgages. They make the money on the front end. And the other reason, and I don't speak with utmost faith that this is 100% factual. First of all, first lien HELOCs are kind of a loss leader for a mortgage company. They don't really make a lot of money on them, which is not a problem, but that's probably why they sell it off, because it's not really profitable until they can sell it, but it's very profitable when they do sell it. So that would be my guess. I just had Harrison in my office on my podcast, and his, him and his family own that company. So.
Cool.
Or no, they don't own FSB. Sorry, getting companies wrong.
I was about to say, bring them on here. Have them come and explain it.
Yeah.
What is the name?
They own CMG.
CMG. All
But
these.
CMG uses North Point as well for the mortgage fulfillment.
Interesting. So maybe this is a follow-up to the other question we had. RJ's asking, can a whole life be transferred to a new owner? Yes, generally speaking. Typically, they want, when you do it, they do want to see insurable interest.
All right, so I'm going to play devil's advocate on that. That is correct. But at the same time, legally, if that went to court, they'd lose.
Yep, I was going to say
the owner of the contract, the client, has the exclusive full right to sell the policy, just like they would sell a car, a house, a deed. Like they absolutely can sell it. Is it frowned upon? Yeah. But if RJ wanted to sell his policy to a new owner, there literally is nothing the insurance company could do. They might push back a little bit, but have an attorney fire a letter, and there's not a. I shouldn't even be saying this, but
I mean, life settlements are an entire investment strategy option. So
there was case study. I don't know if it was Supreme Court, but we could look that up. That actually went through and said life insurance is an asset of the owner, therefore it can be sold. Otherwise, there wouldn't be a life settlement or viatical settlement industry at all, and that's a big industry.
So I can smile again?
Yours is just because you're an agent, Joe. That's all that was. You're just an agent, and they're just pushing back on it, and they kind of got you by the short and curlies a little bit. But if you pushed, you could get it. And just so you know, your camera's a bit fuzzy.
My camera's what?
It's just like it looks like it's out of focus. Maybe it's dirty.
That's just Joe. Joe's just
where
out
the
of
camera's
a
at.
little blurry.
No, it might just be dirty. Like kind of clean it. I've seen that a lot.
Do the grandma clean. Lick your thumb and clean it.
So you don't clean a camera with your finger. You're putting more grease on it. You probably just had some pizza and French fries.
You need a little. Well,
My wife always does that. Like that. I'm way too A-type in OCD, but my wife will like grab her sunglasses that are all smeared, and she'll like start rubbing them with her finger. I'm just like, this should be taught in school.
You got to spit on them first.
You're right. You got to get it.
that's her goggles. That's them. They don't fog up.
I just had a video.
Oh, I know. I did it, and I'm like, damn it, someone's gonna pick up from that. Tui.
Put a little tweet on it.
Well, we're almost out of questions. I do have another question I can ask, by the way, but okay. Well, David had a question.
Didn't reframe that question up.
Yeah. So David Adams says, if an insurer has 100% PUAs on the books, they have zero overpayment of premiums coming in to pay dividends. It seems that a fast-growing company with more new blood coming in would be better for me.
There's not a single insurer out there that could, you could never have 100% PUAs on the book.
Yeah.
Physically impossible. You can't have PUAs without base. It's like peas in a pod. You can't have one without the other. So that is a physical impossibility.
And you're also referring to this whole, insurance policies, but these companies do lots of other products that don't have PUAs involved at all. So keep in mind that of their overall portfolio, how much of their product has PUAs? It's a percentage of it. It's not the entire thing. So that'll never happen.
Look at the next one. So David said,
oh yeah,
when I have a mature policy with lots of PUAs, but again, you can't have a policy with all PUAs. Like, so both ways that we're looking at it, whether it's the insurance company having 100% PUAs or the client having 100% PUAs, both are impossible. You can't just have PUAs. I mean, essentially, it's kind of like an annuity. I mean, I don't know. I don't know what else to call it, but there is no whole life that is 100% PUAs.
But the only time that would happen is when it's only dividends coming in, no premiums coming in anymore. Then it'd be all PUAs, but it's coming from the insurance company's profitability. So
let's go back to David's the paragraph he put before this. Can you highlight that? So what I would say right here, like that a fast-growing company with more new blood coming in would be better. Like I would go the total opposite way. Like the first rule of infinite banking is long-term thinking. The only mutually owned dividend paying whole life companies we work with have been profitable, every single one of them, since the day they opened their doors, all for over 100 years. So the longer they've been in business, the more consistent they are. That's what you want, because you want more control. You want more guarantees. If you're talking like someone that's looking at this like through investor lenses versus.
Let's go back to his original question, because he said, I'm trying to clarify a point with an extreme example. So he's just using examples here, but I feel stupid right now because I don't know what the point is. If something doesn't exist in real life, then we're living in the matrix, and like we're talking about an extreme example that just physically can't happen. So I guess that's where I'm understanding what the point. So let's read this original one. It seems that starting a policy, I would want to pick a company. So we're talking about like what kind of company to pick. Pick a company without a lot of PUAs on the books in order to have more available to pay dividends. I'm looking at it incorrectly.
So having not a lot of PUAs does not give them more dividends to pay.
Yeah, no, not at all.
So so you're thinking incorrectly about how they're structured anyways.
Let me go back and just try this a different way. So a mutually owned life insurance company, what you have to look at is the dividend is just the return of unused premiums. That's a tax thing. It's essentially profits distributed to policyholders. Like they declare the amount of profits, i.e. return of unused premiums by IRS code, that they want to distribute in the form of a dividend. And then they send that out to the clients. So what you really would want is you'd want to look at a life insurance company that is, number one, profitable, which I don't know any mutually owned life insurance companies that are not just stupid profitable. But you'd also want to look at, for me, I'll just talk to me and then I'll flip it over to kind of where I'm thinking you're at. I would want a life insurance company that is extremely conservative in nature, has a long-standing history of paying consistent dividends without lots of variables and lots of fluctuation. Because there are some life insurance companies right now that pay high dividends, but their dividend history is very volatile, if you will, if you go back over a 30 or 40 year period. And then there are other ones, and I'll namely, who was it? The one that Lafayette Life, I believe, had like one of the most consistent dividend scales. Lafayette Life and Security Mutual had like the most consistent dividends out there. Maybe not always the highest, but the most consistent. If you were going for like a fast growing life insurance company, which I don't know of any new mutually owned, fast-growing life insurance companies, do they even exist?
I was going to say, I've got some IBC, or I got some of the other ones for you, the IULs ones out the butt.
I feel like
and they're gone.
Yeah, I feel like if a life insurance company, like a newer one, was trying to grow fast, to me, in my mind, that means that they're taking on excessive risk to try to grow fast. And that would also insinuate in my mind that they're probably trying to grow fast to be bought out, to be sold. I would want nothing to do with a company like that, because then you're going to have a situation like Ohio National or MetLife, and you can already look at what happened there. The policyholders got completely screwed when those two companies went public in Ohio just made major mistakes and got gobbled up. So, but they demutualized. So now they're a publicly traded company. Same thing with Met. And all the clients that had dividend paying whole life policies pretty much got screwed because it didn't matter whether they wanted, more in a dividend. The new company, because they're publicly traded, less focus on dividends. Their focus was on stockholders and paying their stockholders dividends. So you got to kind of pick and choose. Like, are you looking for a stock publicly traded company, or do you want a mutually owned company? If you want a stock company, we're not a good fit. We only use mutually owned life insurance companies for a very specific reason, and that is consistency and persistency.
Yeah,
Well, Chris, you always say too. Well, Chris, you always say too. It's always we're always trying to solve the client's problem. So when we look at one company versus another company and show you multiple illustrations, we always want to understand, what are you really trying to do with this policy first? What are your initial and kind of long-term goals, and will this policy support that? Based off of what we see on the the guaranteed or non-guaranteed side of that tabular detail. So that's really where we try to come at this of understanding what you're trying to do, what your problems or goals are, and then try to find a company and policy design to meet that.
Yeah, and just back to his last comment here, lots of PUAs worse than not much. I addressed that the very first time. I think a company that had lots of PUAs would be better because there's less risk on the books for the insurance company. They don't have as much death benefit on the books that is technically looked at as a liability. So I would look at a company that had a lot of PUAs being better than a company that doesn't. But I think it's still moot point. It's kind of just irrelevant in the grand scheme of things.
Yeah,
David, thanks for going back and forth with all the questions and the clarifying questions. It helped us. I know we're not getting right where you want us to be, but we're giving you the answer, and that literally is the answer.
I was going to say, if someone's chasing the dividend, it sounds like they're treating it like an investment, which it's not. And we need to.
It's okay to chase dividends. A lot of people chase.
It is. But the way it sounded was like my first policy, and it's like, is that where we're at? We're just ready to chase dividends, or are we actually being efficient with all of our money? Do we have our system in place with the best idea in mind? So
yeah, and I think what you just said is super vital. Is everything we do is about a process. So nobody's getting rich, and I'll repeat this. Mark my words, nobody will ever get rich buying whole life policies, even if they're specially designed. All right, let me rephrase it. Nobody will ever get wealthy. Nobody will ever get wealthy off of IULs. Nobody will ever get wealthy off of VULs. As a standalone, they're just a product that solves a problem in a different way, but the death benefit is the underlying reason somebody would buy it. Where you get wealthy is how you use it. And banking is, as you already know, probably one of the most amazing things you could ever learn, and probably the one thing that everybody should know more about that nobody does. But banking is what will make you wealthy. Controlling your money is what will make you wealthy and keep you wealthy. Understanding how to keep your money in motion and keep your money working for you will keep you wealthy. And if you can do all of those things that all the wealthy folks throughout history have done, but you can do that while still earning uninterrupted compounding interest on your original dollars and your original premium deposits, just better. That's the only word I need to say is it's better. And that's all we're trying to do is be better.
Yeah. All right.
Devin Burr popping in. Look at that.
I know, that was cool.
Should pop in here. So RJ says that for older whole life policies that mature at age 100, what happens if the person reaches age 100?
Oh, wow. Anyone want to take that, or should I? That's fun.
You get a big payday.
The policy endows. Thank you, Tess. Yeah, it endows. And what happens when a policy endows?
Money.
Yeah, so when you're 100 years old, I don't know how eager you are to go out and like buy a yacht or go bungee jumping or anything, but you're gonna have a big check. That's all you need to know.
Tax free.
So I got a question on that, Chris.
Yeah, it's tax free.
One of the things I've wondered about that is if you do endow the policy, let's say that there's $1 million death benefit that gets paid out, and you put in, let's say, just for math purposes, 300,000. Do they consider the difference taxable?
Gosh, I don't know.
Good. That's a good question.
Good question. That'd be a question Tess will probably research. And we get back to you on that. I mean, I've been doing this 21 years and I've never had a policy endow. So,
and the answer is yes, though. I remember this from going through the Nelson Nash. Like it depends on how much you put in, depending on how much you're receiving, there's going to be a taxable portion. So
is it up to basis is tax free and after that it's taxed?
probably.
Correct.
Oh wow.
So what
let
if-
your significant other and your kids know that if your policy endows at 100, like 99 to 100, there's some important things that should happen. You
So
should
then-
definitely go bungee jumping.
Yeah.
Maybe go out there and get on a dirt bike at 99 and just pin it, man. Just pin that shit.
Well, I have one maybe better than that, and I don't know if this is doable, but the last day before your 100th birthday, take a loan.
I was going to say that.
Take a loan for the
Take a
$1
loan
million
before it matures.
as much as you can get.
Schedule it out in 50 years.
Oh,
But it wouldn't matter because it was still matured, though.
Yeah, it would.
Well, I'm saying before it
They would
matures.
just at that point when it endows, they'd probably just tax you on the difference.
Yeah, that's funny though.
I don't know.
Interesting question. All
Do
right,
they
so
give
Daniel
you
had
a
good
giant
question.
check, or is it a small regular size check? Do you actually feel
Whatever the
like
death benefit is.
No, shoemains are like, is it like one of the ones when
Yeah,
you
one of the
receive,
big
like an
checks.
award?
Who did that? That
Balloons
was
at your
the
door.
sweepstakes.
I mean, if you're 100, they probably do the kind of check you wanted to. I mean, they might take it,
Well, it's got to be big enough so I can read it.
Right?
Whoa,
We won't say that.
Joseph.
Joe, you're only a couple years from 100, man. They don't rush. Okay.
Hey, when I'm having my 121 birthday party, I want a ding dong at the door, and I want them to say, "Here you go. We're done. Take your toys. We're going home."
He told us we have to keep him on life support and just keep trading out the parts, and they need to be traded out.
Beep.
You're gonna deposit that check in the bank, and they're gonna put a hold on it for 10 days.
Yeah.
Convert it to a
We're fine
121 policy.
The electric would go out that night, right?
Oh, this is a familiar question right
Good
here.
question.
Yeah, I feel like we just went through this one here a few hours ago. So Daniel's asking, if you want to get a policy for your child, when I say child, I'm assuming under the age of 18, what is required as far as the parents' policy? Can the parents have a term and child have whole life? So, for sure. The second part of that question is yes, you can have term insurance and they can have whole life. It's just death benefit, but someone else can take the first part of that. We talked about that today.
I think this is a good one for Ethan.
Sure. Yeah. So yes, depending on which company we're looking at, yes, the parents do have to have a policy. As we kind of said with the term, it doesn't have to be a specially designed IBC policy, but typically we would want to start with the parents. The breadwinners of the household first. So usually you can have up to about, if the parents had, say $1 million of coverage, the kids could have up, about half of that or $500,000. Those rules vary a little bit from insurance company to insurance company.
Yeah, but Daniel,
I've done it many times where we put term insurance on the parents because the focus was the kids. So we put big term policies on it. Didn't cost hardly anything so that we could ramp up policies for the kids and set the second generation in place.
It's an opportunity to do a convertible term too. Lock in your insurability at that time. Get more insurance on yourself so you can do what you want, or maybe the grandparent wants on the kid.
Well, in the case that I had, it was simple. Is that they only had a specific budget. It wasn't a big budget. They were in their late 50s, so if they put money in, they'd literally be just hitting the surface of the minimum. So they said, "Hey, can we just do this on our children?" But they had no coverage. So what we did is we put, I can't remember the type of term, 5-year term. It was just to get the kids in place. So we did a 5-year term policy, which then gave us the ability to devote the majority of all the money they wanted to save to the kids, and it worked really well.
I have a scenario where there's 3 kids, 2 of them are close to 18, one is very young, and the insurance company is not letting them do the policy on the young one because the other 2 don't have coverage or very much coverage. They have this small coverage.
Okay,
So and they can't put that much into the premiums, and so they said, "Hey, we don't want to get a whole life on them because when they're 18, they can go do their own thing."
this
and
is
so
an
the
interesting
client actually
one.
said this. The client said, "Oh, wait a second, this other insurance company, which is a stock company, I believe, will do term policies on the juveniles." So I said, "What if I just go get a cheap juvenile policy on them?" And I'm like, "Yeah, that would work because they're talking about the death benefit. The insurance company is saying we want the death benefit to be equal across all 3 kids."
Just not
So that's what the clients are doing. So they're going to go get term policies on the 2 older ones, and then get the whole life on the younger one. So
That's a cool way to approach it too. I've never even thought that before. I've never even thought, hey, since you have to have the same amount of insurance, right, death benefit on them, you could even do convertible terms for them if they wanted to as well, right? Or just a regular term. You could do either for the older ones.
yeah, and some companies, I don't think is it true that some companies don't do term on juveniles?
Yeah,
Well,
yeah.
If they're
Yes.
18, no?
They're not 18 now. They're 16 and 15 or 16 and 17. So
Mm.
yeah, so there's lots of ways to do this. I guess this is kind of the point right there. Lots of ways to make it work.
Hey, real quick shameless plug while we're at it, since we got a nice audience here. Tomorrow, I'm doing a live presentation out back here at our studios. Now, I know all of you live in and around the Buffalo, New York area because this is just the bomb kind of place to live. So I'd invite all of you to come on out tomorrow at 6 p.m. to watch the presentation. But for those of you that, maybe aren't the cool kids living in Buffalo and you can't make it here and you don't want to get on a plane, you can come right on the same place you came here. We're going to be streaming live on StreamYard the entire time. And I'm going to be doing a pretty unique, I don't know how it's going to go, but I think it'll be fun, presentation that'll be teaching the infinite banking concept and how to take back control of money. But I'm going to be doing it where it's very personal and very kind of near and dear to this area and my upbringing and everything that I've done to use it. So if you guys are free, 6 p.m. tomorrow Eastern, join us right here on this StreamYard on Facebook, YouTube, or any of them. We'll even stream on Instagram. So check it out.
Cool.
Oh,
Awesome.
can someone send Devin the AMA link so he's got a video he wants to share, which will probably be good.
Yeah.
Who's got that?
Tessa's on it.
Okay, cool.
Knight of Israel says, can you take a loan too soon after starting a policy? Will it stunt the growth?
No.
Not with a non-direct recognition company. It won't matter. But yes, you can take a loan too quick. So I had this happen to a client. She might be on right now. She went to take a loan from One America like within 1 week after the policy started. And she's like, how come I haven't received it yet? Because they require a 30-day window before you can take your loan. So,
and not all the companies are that way, but most of them would like your check to clear before you take a loan.
Yeah.
You want me to even get crazier? Here, let me.
Oh, I have a case that's going.
Client took a loan before their check cleared. They didn't even have the money in there, and then they took a loan. I don't know how that one slipped through, but that was fun.
Yeah, is that my case? You might be referring to my client where that happened, and
there's something wrong. There's something wrong with that one, Brian. I'm definitely not talking.
Yeah,
about
the insurance company.
This client actually put a deposit into their policy.
Oh, okay. Yeah, this client did not, and the insurance company
gave him a loan. I know,
and never took the premium or dump it.
Yeah,
3 months.
Good luck with the life insurance attorney floor.
Yeah, that's a.
I smell bullshit on that one from day one.
Yeah, something's going on there. All right,
smart thought though. Hey, I mean, kudos for him trying.
Yeah, that's yeah. All right, moving on. So Dexter says, for my grandkids, I have small policies with One America, no loans on them, just premiums. Should I mech them for max growth for later borrowing for them?
No.
I would never recommend that. No. I mean, you know if everybody else would.
No. Please don't.
So there you go. Simple answer.
Just run them right up to the limit and then open additional policies.
Yeah, Dex, that was almost as scary as you calling Joe hot before.
Best way to start at the age of 18.
19.
Simple. Schedule a call.
Yeah.
That's
awesome.
it.
Schedule a call to one of our mentors. And
can all of you on here imagine if we could go back to 19 years old?
Heck, I'd go back 10 years ago and be happy.
Oh, yeah.
I mean, Devin got my memo about the hat. Look at that.
Wow, look at that beard.
I know, it's rocking.
It's like Grizzly Adams up in here.
Oh.
How are you guys?
Hey, he made it.
See you, Burr.
Good. Good.
Yeah, I have a client right now. It's 19, graduated, or 19 with his father. They're both doing policies. That kid's gonna be set for life. It's gonna be awesome. Gonna be cool. All right, Dina, follow-up question. So she's thinking a whole life policy on one of my children or grandchildren could help me. Am I thinking right? Yes, you are.
For sure. And you'd be able to do that because your health, we could easily do like a preliminary underwriting to show that you're not insurable, and then they would allow you to do it on your children.
Well, and age-wise too, she couldn't do the policy with infinite banking anyways.
Mm-hmm.
Yeah. Just schedule a call. In fact, if anybody wants to put the call link in there, we'll do that. Let's see here. So Dave Mann says, what is the max death benefit I can get on my child? I have 6 million policy on myself. Roughly speaking, probably 3 million.
No, great question. It's usually still going to be limited up to $1 million, Brian, unless we can show for estate planning purposes why they can have additional coverage on them. So
I was actually looking at Lafayette's numbers right here. They said 2 million individual consideration above 2 million. Please send cover letter explaining the need for insurance amount on the juvenile.
Yes.
So that's it right there. So yeah, you can do it, but you have to have as he said, a solid reason.
Yeah, estate planning is usually a really, really good reason to do. Like that's how we got around it with one of my big clients.
Yeah. So Shane, follow up here. So my One America policy has a monthly of $833, base of $350. Is it possible to change the monthly to just base per month, then prepay the balance of $483 times 12 for accelerated PUAs to fund account?
I've seen that
You
done
can-
like once or twice. And yes, you typically you can usually do that. I would rather see you just jump up to a quarterly or semi-annual or annual premium. But yes, that I have seen that done a couple of times. I don't really like it, but you could do that.
Okay, there you go.
And why don't you like it? Just curious.
You couldn't. I don't think you could do that with Mass Mutual.
That's probably true, Chris. I get in my opinion, and tell me if you guys think I'm off. In my mind, it seems kind of a little bit short-term thinking of trying to get too much money out of the policy. I'd rather see you as you're saving up more money or able to pay yourself back faster, use that to push your policy ahead and then pay the whole year's premium in one shot.
If I had to guess, the reason Shane might be trying to think about doing something like that is he might just be trying to buy another one of those Honda Pilots for his Turtle collection, which might just be just a wee little bit short on the amount of cash value he has. Just trying to figure out why he would want to do something like that, but that would be
It's very specific math too, right?
Yes.
Like you're doing 483 times.
That's Shane for you.
Yeah. Yes.
He's
When
like,
I
all right,
first
that
read
Honda
it-
Pilot costs this. I just need this much more.
When we first brought it up, I was just thinking, Shane, just ask how much additional can you put in, because you're trying to put 483 times 12. I was reading it differently and just ask them how much additional can you put in, because you can do 3 times the base every year minus what the PUAs that you're already putting in, right? So
There you go. So I want to show this one right here. So Gloria, she said she took a policy loan from One America a week after funding it, which this is a recent policy. So Gloria, did they actually send you the funds before 30 days was up? Because if so, that's...
I've never heard this 30-day thing. Ethan, is that?
me neither. I've got policy loans within 14 days
I
before
know
Brian.
people from One America that have gotten loans before 30 days. What about
Yes.
what are we missing here?
Isn't there the look back period too? Sometimes we have to remember, but this one's a
Well,
week.
the look back period is going to be the
Look
case
period.
with almost all of them, but it's usually that's a 10-day free look.
Okay, yeah. So she's saying, yeah, she did. So because somebody came and told us that One America sent us something out saying that it's 30 days, but
They're lying to you.
yeah. Yeah, I don't know who it was that said that. Yeah, I don't remember. Cool.
Yeah,
That's
never-
awesome.
You said that, I'm like, okay. I mean, maybe you know more than I do.
Well, it's one of our team members that said it, but I don't remember who it was. So it wasn't me. All right. So a casual crediting game. Love that. So do all mutual insurers offer a rider on juvenile policies that guarantees future purchase of additional premiums? I don't know if that's the correct term for it.
Yeah, I know what he's talking about. So there's an additional rider. I don't know. I to be honest with you, just because we're so boring in what we do one thing and one thing very well. We don't really look at all the bells and whistles that can be put on, but I'm pretty sure the majority of the companies we work with would have that rider. All it does is you're buying future insurability for a child. The ability to buy additional death benefit into the future at a without any underwriting.
Yeah, she's saying purchase of additional death benefit. Yeah, I've seen that in policies. Illustrations.
We used to do a lot of that at New York Life. That was a big deal.
So yes, yeah. So. Lipo roller. Okay. All right. I have 3 policies: Penn Mutual, Lafayette Life, and Security Mutual, with the PM being 14 years old. Penn Mutual. Should I consider exchanging for another one that is non-direct? Am I losing dividends and interest by keeping it direct? In most cases, that's too long has passed. You wouldn't really want to exchange it because it's pretty efficient at that point in time. Most times we would not recommend moving it over unless the policy build was horrible. Which, by the way, I have seen this where someone had a 14-year-old policy with a direct recognition company and their break-even point wasn't until year 20 or 22. It was horrible. So it's just math, by the way. It's just math. So, I mean, I would just recommend scheduling a call and we can, go through it with you, but mathematically, probably not.
What you could do also, guys, is you could put all the policies together in a cash value line of credit. So basically what you're doing is you're just having your cash value as collateral, and now you're borrowing from a line of credit from the bank. So since you're not borrowing from the policy, it doesn't matter if it's direct or non-direct. So that's something that I suggest that people do if they get a lot of policies, because if you've got a bunch of policies and you're borrowing from this one and this one and this one, you're repaying this loan, repaying that loan, it can become a logistic nightmare. If you're bundling them together and borrowing from one place, it just makes it so much easier, and you don't have to worry about it being direct or non-direct.
I'll second that. I mean, all of my policies except for one are in a BOOSI cash value line of credit, and I've been really happy with BOOSI Bank. There's no affiliate commissions or anything. They don't pay us anything, but the loan interest rate just came down at 6.7% on the CV line of credit. So you really got to factor that in. You got to factor the convenience with the additional cost, because obviously with the insurance companies, most of them you can borrow less than 6.7%. So you're going to pay a little bit of a premium, but you're going to have a lot of convenience. And for me, the simplicity of having one central point is well worth the added cost. And I know that cost is down too.
One other thing too, Chris, is I didn't really notice this until I got the same thing, BOOSI Bank. So I have 15 policies. They're all bundled together. Makes it so much easier. But when you borrow from a policy, you've got a surrender value and you've got a cash value. A surrender value is always a little bit higher because there's premiums that are held back, and then you have your cash value you can borrow. So when you bundle them with BOOSI, you can borrow up to 95% of the surrender value. Mm-hmm. So you actually have access to more money.
Yeah, no longer is it that 10% rule that we always talk about.
Yeah, so you have access to a little more money. It's the interest rate might be a little bit higher, but what I really like about it is you have to make a payment. With life insurance, you never have to make a payment. So human nature can set in. You can be like, you know what? I'm not going to pay a policy loan back. That I think is a negative thing. Paying policy loans back is a very positive thing. So with BOOSI, you have to make a payment once a quarter. So it just gets you in the habit of being an honest banker and always paying loans back. For someone like everyone on this call who makes premium deposits and makes premium loan payments all the time, it's not a big thing. But if you're in the habit of not paying them back, getting a cash value line of credit gets you in the habit of actually doing that and being an honest banker.
We should literally create like a jail, and anybody that's abusing their policy, we should force them to do a CV line of credit so that they have to be an honest banker.
Unless you're doing a HELOC.
Like a probation. Like you're on probation. You're not being an honest banker. We're putting you in a CV line of credit where you have to pay.
Well, think about it.
I never thought about it that way. That is good. That would. I'm so conditioned, Devin. Like I'm so like, I don't know any other way anymore. So like for me, making payments back to the policies, you know, the loan repayments is just part of it. If I ever use money, I've already got the repayment figured out. I've already sent the email to BOOSI to increase my principal. But for a lot of people, like they're just not good at that. So Craig and I have got something coming that's going to fix that for a lot of people and make it so freaking easy that if they don't do it, they're just, I don't know, they're bank robbers. That's all there is to it. I mean, listen,
I was just going to say,
there are bank robbers out there.
Yeah, Chris, I was just going to say, if you go rob a bank, you're going to jail. So you rob your own bank, you're going to jail.
Yeah, that jail is CV line of credit. BOOSI would love us for that, Devin.
You're building that jail behind the offices there?
How do you spell that?
BUSEY. They used to be M&M Bank, I think.
Their client service, guys, is unfreaking real. That's something I'm really big on, is client service. I came from working at Rocket Mortgage, Quicken Loans, before I got into real estate. And their biggest thing was client service. Like if you didn't return a phone call within 24 hours, you could lose your job. So I am huge on client service, and BOOSI is phenomenal. So far from working with them, they've gone above and beyond.
I agree. Like I've been beyond thrilled with them. And, I don't think we ever really talk about it just because, well, I mean, we just don't talk about it. But that extra 10% that we have access to, I mean, that with the size policies that we have, and I'm sure a lot of these folks on here have lots of cash value. I mean, that adds up a lot. I mean, that could be $100,000.
Hey, Drake, I'm talking to BOOSI Bank. Can I get up on my affiliate? Oh, crap. I wasn't on mute. Sorry. I'm just kidding. No affiliation. I mean, we just really believe in using that cash value line of credit. It makes it easy.
Yeah, if anyone's interested, Brandon said he's happy to give you guys the contact. Brandon@chrisnaugle.com.
Cool.
Hey, before we move on, I would just want to go back to the question about the guaranteed insurability. I had to go look it up because I remember seeing it, but it is on One America. It's on Lafayette. So yes, you can do that.
Cool.
Good to know.
All right.
Couple last minute questions. So Justin says, could you do a set amount policy at a juvenile, but once they turn 18, make the policy bigger, or at 18, just make another policy? I'd assume it'd be easier to make a new policy. So yeah, a new policy.
New policy.
Yeah. So you answered your own question. You're welcome.
Hey, Justin, what do you think this is? Gerber Life?
Yeah, there you go. So Zircon.
Well, actually, Western Southern owns Gerber
that.
Life.
Yeah.
So
Yeah.
Well,
Yeah, that's a small company. If I open a policy on my 20-year-old college grandson and something like death happens to me, what happens to the policy?
Would
That's up to you.
Yeah, it's up to you. I mean, you could designate a successor owner. So, but typically I would think it would probably just be owned by the insured if the owner passed.
Well, does it go into your estate?
Maybe it does. Yeah. But then your estate should have some direction. So put it in your will that this person
Right.
would be the owner of it. Remember, it's an asset. That's the biggest thing I think a lot of people forget. It's an asset. So just like everything else, you got to tell the state and, the Fed, here's what I want to happen to my assets. It's a will or a trust or any of those provisions. You got to get that stuff done.
Yeah.
Even just like on the beneficiary change form, you can usually specify who the contingent owner is in case of your death if you're the owner. So just to check your boxes, I would say definitely have it filled out there if you want the policy to revert to having the insured become the owner.
That's what I was thinking. Contingent. I said successor.
There you go. All right. So last minute questions we got here. So there you go. So that's customer support. So Devin, you mentioned that. So Dexter's talking about our implementation team, which is awesome. Hey guys, very interested in setting up a policy soon. How much does your credit score impact your premium rates? Thanks to all.
Yeah, not much, if any.
So I always say it's not your credit score, it's your credit profile that impacts it more. Credit
Right.
profile is how you handle credit, and they can see it. So like, do you have a history of not paying, loans? Do you not have any credit history? Do you have a history of, using all your debt and not paying it down? That's called credit profile, which is something that people don't think about. So that's just your way of handling debt. That's what more they're looking at is it's not your score per se, it's your profile. So kind of keep that in mind. So I've had that come up on clients where their score is great, but they have something in the back, the history that the insurance company sees and they're saying, hey, what happened here and what's going on with this? And so it actually just came up today with a client. So keep that in mind.
if your credit score is low because of a bankruptcy, that might throw a little wrench into it. But
Yeah. So so then we put in we'll put in the link into schedule a call with one of our mentors in here. So for those of you that have questions and want to hop on a call with us, just grab that link, schedule a call with one of our mentors, and we'll dive into it.
It's scrolling right in the bottom too.
Yep. I'll put
You
it up
can see
there, yeah. All right, I think that's all the questions.
Anything else from you, Beardman, for your guest appearance today?
What's funny, guys, with this beard, I don't know what I did with my hands before the beard. I literally just touched the beard all the freaking time. So before I had my beard, what did I do with my hands? I don't know.
Don't tell us.
Please don't
What do I
answer
do?
that.
I don't want to know.
It's PG here. We don't want to know.
And
My
David,
wife
did
says,
you want to
"Stop
post a
petting
video?
your face."
Stop touching it.
Were you going to post a video or something, Devin?
No.
I thought you were going to come down and post that new YouTube video that you said you just did on this.
No. I just got done recording it and sent it to my guy to edit. So I was on YouTube, saw that you were live, so that's why I jumped on.
Gotcha.
You just wanted to hang with me, Devin. Face it.
I always want to hang with you, Tess. I miss you.
Miss you too.
All right. Well, that looks like it's a wrap. So, folks, tomorrow, 6 p.m. Eastern, if you got some free time, jump on. Same place, same almost time, but half hour after this, and we'll have some fun. You'll hear some cool stories that I don't think I've ever really told. But with that being said, thanks for joining us. Thanks to all the mentors and the attendees for the Brady Bunch showing. I appreciate you, all of you, and we'll see you very soon.
Thank you.